Welcome, everyone. I'm Angelo Robles, the host of the Angelo Robles Podcast on Apple, iHeart, Stitcher, Spotify, and other platforms, and the founder and CEO at Family Office Association. Thank you so much for joining us today. We're really excited. It's been an amazingly active summer for us, and I've been so fortunate to have interviewed some really amazing guests. I'm really excited for our two guests today. One of them, Chris, I've known for probably only about 8 or 9 months or so, introduced to me by a family office. So those are always very cherished, and has an amazing background in a family office himself, but also as an entrepreneur and a VC investor, especially looking at it, although based in the Bay Area, from a global perspective, including Asia, where there's some tremendous opportunities. So on that note, the title of today's session is A New Way to Solve the Access Problem in VC. And for sure, sometimes even for the biggest families, that has been a problem because the old guard and many of the institutional investors keep on re-upping at a lot of the so-called dominant and classic larger firms. And it's been that way for a long time. But there are dynamics that are changing, and we have certainly two entrepreneurs that are looking to do that today. We have two guests, as noted, Chris Shen. Chris is the co-founder of Project M and West 22nd Capital Advisors. That is a Hong Kong-based family office. We're also joined by Eric Wu, CFA, who's co-founder as well of Project M, and formerly head of institutional capital and Asia growth capital at AngelList. Gentlemen, welcome to the show.
Thank you, Angelo. Thank you for having us.
Always great when there's two guests on, and I do to thank you to see kind of who goes first. Well, I mean, you guys have such a great background, and I know with Eric having significant role at AngelList, and that's going to relate certainly to part of our discussion about the access problem and how things are evolving and getting better. Naval Ravikant is an extraordinary entrepreneur. Back in 2014 at the University Club in San Francisco, let a memory by Angelo. He was interviewed in a session by one of my members. I believe that was Kai Tao, if I remember correctly. And, you know, Naval's a great entrepreneur. So many of our families know we're incredibly intrigued and interested in entrepreneurship, earlier stage investing. So we look forward to getting right to it. Gentlemen, I'll let you choose who goes first, but I'll start very broadly, especially now during COVID. What's the current state of the VC market?
Eric?
So happy to start, and Chris, please feel free to infuse your views as you bring in some elements of kind of the global and political environment. I think a lot of venture today, it's mainstream. I would say that's my first comment, in the sense that it is become synonymous with innovation investing, and all you have to do is point to the leaders in the public markets to know what are the companies that are the leaders and top of mind for a lot of investors. They're the tech companies. And as you start to peel back the onion and people start to appreciate that these tech companies were once venture-backed companies with aspiring founders that were trying to build a product, carve out a niche, and now those are billion, if not trillion-dollar companies. So that as a backdrop, and especially in light of what we've gone through in terms of a tremendous and tumultuous environment of the pandemic, of not physically being able to do business, it's led to a greater reliance and a greater awareness of what technology does and playing a role in our everyday lives. So in short, it's cast a even brighter and wider spotlight on the role of technology and startup companies and the products and services that they are developing and how they affect our everyday lives, whether that's from our personal standpoint or how we do business. So with that, I'll maybe hand it over to Chris to talk a little bit more about sort of the cross-border angles to that, the cultural sensitivities around how people adopt and interact with technology, because I think those are all considerations for investors to think about if they're interested in venture today.
Thanks, Eric. And thanks, Angelo, again. Coming at it from more of a cross-border angle, I would say that even before COVID-19 and the current public health issues, you've seen sort of a movement away from, sort of interconnected ecosystems to obviously the big precipitating event was the US-China trade war and sort of the sanctions put on even before Huawei, ZTE. And now we're seeing that play out with TikTok. I think innovation is always a necessity for any country to sort of compete, survive at the end of the day. And you're seeing that where, as the two ecosystems get more bifurcated, supply chains aren't going to decouple overnight or anything like that. A lot of this is politically driven. So you'll see a lot of, some kind of resolution going into November. But I think the climate in, sort of from Main Street all the way down to Wall Street and into venture capital is that we're seeing a new normal that's, just getting accelerated by sort of the public health issues. So innovation in different ecosystems, be that China, Southeast Asia, the US, you're going to see sort of new companies, new ideas pop up to support those ecosystems, where in the past it might have been an American company or a European company filling that gap overseas. Whether that, we don't make a comment on the political situation, but you can see sort of, if you know how to trade it, if you know how to trade the public markets, because those are, going to be affected, but also play in the private markets where you work with the right partners, whether that's in the United States, in the Middle East, Europe, or Asia, you have opportunities to generate investment returns on all these different companies that normally would have been correlated and competing against each other. But because of the bifurcation of these ecosystems, the correlations break down, and it could be interesting to see where they end up in sort of the competitive landscape in the future.
Yes, and when I think of the current state of VC and certainly impacted by COVID, there's a couple of things that pop to mind. Would love to get your comments on. One, lots of secondary activities as the IPO market has been active. Flavor of the week, the month has been good for some big names.
Yeah, I would say, Angelo, the public markets are ultimately the final arbiter and judge of the venture capital asset class, right? And it's been a 10+ year bull cycle, and a lot of the companies that have been founded over those 10 years are now going through the process of exiting, of hopefully replenishing capital back into the early stage ecosystems, because as startup founders that become successful and go on to their next businesses, or they become angel investors, this is a very critical component in terms of the life cycle of venture capital. So on that note, I think it's obviously a prosperous time in terms of minting new money, but it's also going to be a wellspring for the next generation of founders who are looking to build their businesses, and they're going to have a wider and broader and receptive audience to help them along in that journey as like I said, angel investors or first-time seed funds trying to give back to that ecosystem. The final comment I would make in terms of the IPO market, IPO market today is, you can't speak to IPOs without talking about unicorn companies and the late stage private markets. And I think where we have come a long way over the last, even 3 to 5 years is late stage venture, both in terms of the dynamics, the structure, the players, the investors, is become very similar to how public markets are traded and how public markets are perceived. So I think that's an interesting jumping off point to talk about, some of the structural issues around how venture has changed and how that is drawing in a new and different crowd, net positive because it's more capital. So I'll save that as my last piece and maybe hand it over to Chris to comment on that.
Yeah, just, not much to add there on top of Eric's comments, in that perhaps looking at sort of the macro and secular tailwinds behind, I guess, late stage and sort of pre-IPO investing. If you see sort of what has responded, and again, not commenting on politics, but into November, policies, regardless who's in the White House, policies are likely going to remain sort of soft and accommodative. you know, sort of the quantitative easing and sort of interest rates across the world, you know, likely aren't going to change as much despite sort of some V-shaped recoveries you've seen in certain countries. So with this accommodation, you know, markets will trade at a certain level. I think a lot of the smarter investors are seeing that, you know, this, how can this go on? And I think too, with interest rates depressed, obviously that has an impact on sort of the fixed income market. So then if you look at kind of where private wealth managers, asset allocators, you know, all the way down to high net worths and single family offices where they need to put their money and find sort of yield and find sort of those returns for the risk they take, you're seeing quite a bid and quite a interest into later stage venture capital, which I think then trickles down into earlier stage, as well as also ESG. I think, you know, those two things go hand in hand in terms of innovation, and it remains to be seen. It should be interesting to see how this plays out.
Yeah, I mean, you look at today's times, the inability to time a vaccine or enforce shutdowns, et cetera. There are some aspects of entrepreneurs and earlier stage companies that this is potentially a boon for them. Home tools, e-commerce, media, but for sure, there are others that are negatively impacted, primarily those around travel, retail, and hospitality. I guess like in anything, you need to be tactical. There will be winners and losers. And even among those that we think are going to be winners may not play out that way in a year or two or whatever, 5 or 10 years, and vice versa. Maybe it's a time to get into a dislocated market, a lower valuation, depending on the entrepreneur, their mentorship, their investors. I mean, if investing was easy, we'd all be doing it and making, 50 or 100%. It's really hard. And happy to go into the next question, which is, what are some trends in venture capital that people should be aware of, besides what I just said?
Yeah, maybe I'm going to talk a little bit about sort of the structural issues that we're going through, and then I'll let Chris comment about maybe some of the sector-specific trends, given, you know, his family office background. He's seen and operated in a lot of different asset classes. So the structural issues, I think, are, you know, have been in the making for the last, 5 to 10 years with respect to. There's really three layers to the venture capital cake today, right? You have at that upper end, this pre-IPO, late stage unicorn market, which, as we mentioned before, trades very similarly to kind of public markets. And then in that middle layer, you have, you know, what we call growth stage. So growth stage today are the handful of the branded top tier VC names that, you know, many decades ago were really the pioneers of venture. Now they become, you know, big brands, and by virtue of that brand and that marketing machinery, they can raise a large fund and can help companies get from, you know, the post product market fit to the market leadership stage, and so on and so forth. And then at that final, you know, lower level slice of that cake is really, you know, early stage venture. And this is, you know, the true sense of that word of venture capital. You know, the seed stage to Series A stage companies that are looking to prove out their models, build out solutions with some pilot customers, and get to certain metrics of revenue that would justify that follow-on round of financing. So, you know, I highlight this, you know, this layering, if you will, and the stratification, because historically, venture has been somewhat of a monolithic, black box, opaque industry where you had, you know, very few sources of capital, meaning there were some franchise names that were, you know, essentially closed ecosystems of capturing the entire stack of venture investing from that first check all the way to pre-IPO. And with that decoupling and, you know, sort of deconstruction of that stack into these different three slices, as we talked about, it's offered the opportunity for different types of business models. It's offered the opportunity for specialist investors, you know, whether it's a specialist seed fund or it's a, you know, a secondary platform that provides fintech for people like retail investors to get access to unicorn names. That has enabled more players. It's enabled technology to play a larger role in terms of, you know, getting that access, which is, again, all very, very positive things for the asset class, because we need to continue to bring awareness across a number of different LP profiles in terms of doing venture.
For sure. Chris, any follow-up commentary?
Yeah, I think, in a similar vein, I guess, without sort of rehashing kind of what's going on macro, secular, the different tailwinds, I would say just dropping into sort of what families cross-border, and we talk to these families every night, Asia time mornings, across sort of Japan, Singapore, China, Hong Kong, et cetera. Before it was more, venture is a shiny object where, someone's coming out, there's this unicorn, this household name, SpaceX, Palantir, whatever name you want to use, where people were like, okay, that's nice, neat and shiny, what's going on, what's the pricing, et cetera. But I found that in the last, I would say, 5 years or so, with, as Eric mentioned, the rise of secondary platforms. I think Dave just asked a question about Carta and sort of the marketplace that they're looking to build. It's democratized, I guess, that access. It provides flows into it. People are, getting more sophisticated about the asset class, more so than ever before, right? I think two, with that access and that access to information, then people start really building out, adding sort of what their personal sort of interests are, their target returns, what sectors they're traditionally focused in. I mean, one example of, someone we work with is a family office based in Southeast Asia that owns hospitals, right? So they're looking to standardize and sort of bring in digital health concepts that we would, I guess, in the US, due to sort of regulatory issues, take for granted, so to speak. Mm-hmm. These are interesting trends. So I think families have relying more and more on sort of their teams to go out there and do the deals they want to do. Some with a strategic bent, I mentioned the hospital digital health example, but some are just, they see it as a good deal. It generates X amount of returns and it's worth the risk for them, and they go from there. So that's been interesting. I'd say, obviously health, given sort of COVID-19 and public health issues, has been very popular, definitely getting a bid. Everyone knows about future of work and sort of how, add another overlay to Zoom and, work from home and all that. But I've also seen sort of interesting things in ed tech, where I think a lot of people here are parents, their kids are, sitting in front of the camera, trying to, take in curriculum and, coursework, et cetera. That's been interesting. And I think from a geopolitical cross-border perspective, if you take out the content aspect of that, this is something that, different countries and different ecosystems can all agree that's important. Their future generation, how they educate, how they diagnose, how they monitor. So that has been not so much of a victim of the trade war as other sectors have been and will be. So that's been interesting too. So more specialized, more opportunities to find alpha, and some common ground in different ecosystems is what we've been seeing.
And I mean, would you say the early stage proliferation of super angels, nano funds, micro funds, many are very specialized, and the new generation of those are former operators now turned investors?
Yeah, it's we are now going through sort of the next rotation of what the early stage players, and just a little bit of a a history lesson, given that I started my venture career about 11 years ago working for an institutional fund of funds. And at an institutional fund of funds, you pretty much were repackaging and selling the fact that you had access to a big brand name VC. And as long as you had that access in your portfolio, you had a value proposition for somebody to give you a lot of capital and earn fees off of that. And my experience there was somewhat, I would say, as an entrepreneur who is working in sort of this construct of a corporate entity, just sort of, doing same things, the same things over and over again. I started to see what you described, which was, the early starts of seed funds and micro VCs starting to be the first check writers in these companies. And again, there was still kind of a debate. Are you a generalist fund? Are you a seed stage fund? Some people said, I still remember this, like, gosh, if you're a specialist, is your market too narrow, right? And this was a fund that was doing real estate tech. It was, granted, the first real estate tech brand in micro VC, But you know, today that we all recognize that it's a very large market. You know, despite what at that time might have felt, you know, somewhat hyper specialized. So that evolution in terms of how those funds get started, how they interact with that founder ecosystem, these are interesting, important social and cultural elements to venture that are hard to appreciate unless you are part of that fabric. And I know, you know, if you're a GP living in Silicon Valley or an angel investor living in Silicon Valley, you see this and you live and breathe this every day. But if you're in the Midwest somewhere where you can't physically be on the coast, it's hard to, you know, sort of ascertain a value to what that means. But when you zoom out and we go from this it's now widely accepted that, you know, look, seed funds, micro VCs, they're not going away. They play an important role in terms of vetting and working with those founders to get to, as I mentioned before, the metrics that would justify a larger brand name VC to come and follow on. And then now as we go into the next generation, it's further, as I, you know, kind of use that word, stratified this, that, you know, seed stage today is no longer one round. It could be 3 or 4 rounds. And so what happens in terms of who is the player, who is that, you know, pre-seed specialist, or who is that player, who is that post-seed specialist, right? These are all things that are happening before that branded Series A round of financing. And it makes for a very rich experience in terms of investors looking to do early stage with a particular view in terms of sector, stage, or geography, and being able to represent that view through a check of writing it to an interesting founder or angel investor. So it's a natural evolution. I think venture by its nature is going to continue to evolve, because as long as the startup ecosystem is evolving, the investors have to adapt with that. It does make it harder. It does create more noise. And I think part of, you know, what, you know, we want to help educate at Project M is, you know, we need important intermediaries, right? And those intermediaries, whether they're consultants, advisors, you know, fund platforms, technology, fintech platforms, they all serve a role to bring greater transparency, greater access, and a greater, I would call, sort of a diligence layer to the early stage, which I think are important infrastructure components for bringing more capital into that part of the ecosystem.
And Chris, what are your views of unicorns, tech valuations, and the overall markets for the rest of this year? Is now a time to even invest in VC?
That's the well, I guess you said the multi-billion-dollar question. You know, no crystal ball here. Don't even pretend to have one. But I think from what we've seen, and you know, I'll let Eric sort of chime in as well with his views. You know, with everything sort of going on in the markets, this has not made anyone gun shy. I think initially when sort of the markets really took a dive about 5 months ago, that end of March, you know, people were trying to figure out sort of what was going to happen, you know, runways with different companies in the public markets, you know, sort of, you know, was this the bottom, et cetera. But as we've seen, you know, if you sort of look at where the tech names have gone, I brought the rest of the market up with it. You know, everyone's kind of sort of settled or sort of understands what's going on in their public book, and now they're looking at sort of other asset classes. So when we were working with our, you know, friends and families and clients, primarily in the US, but also a significant portion in Asia, right after that, I would say in late April to May, that interest came right back in terms of looking at sort of the names and sort of, that was when a lot of the news came out around SPACs. Everyone was raising a SPAC, all the hedge funds, all the different sort of, you know, sort of different investors that are very, very good investors. And then direct listings have been around for about 2 or 3 years or so. So I would say that, you know, the channels for exit, channels for achieving those liquidity events in traditional sort of M&A, a lot of companies were being opportunistic, buying little companies then was around. So that sort of gave the investors the confidence to kind of jump 2 feet back in. So what we've been seeing a lot of is like a flavor of the week almost, like ice cream, right? You know, SpaceX had a launch. The week before that launch, everyone was looking for SpaceX. Also, although, you know, they raised a round as well, a primary round, and I think that was a Series N or something, which is, if you think about a Series N, pretty incredible. but other companies that are kind of getting ready to go public, that have filed recently, et cetera, or that made the news, or SPAC sort of rumored targets, those have all been getting a bid. So not to put a crystal ball or an overlay in there, but if you sort of figure out what the market is doing, I would say that the market still expects sort of these unicorns or these companies approaching unicorns to still go public in a decent amount of time, and then a decent sort of window of time, so to speak. And then two, the sort of the demand and the thirst for those companies are still there. I would add one more thing before handing to Eric, in that we've also been talking, to a lot of, not family offices, but the ones that serve family offices, gatekeepers, advisors, I would say more MFO, asset management firms, and private banks. And they are actually setting up programs to look at these late stage companies where traditionally their bread and butter has been sales and trading. It's been sort of, traditional fund products, packaging things up and letting their RMs sell. That has been really interesting because again, going back to the original sort of thesis and sort of what the market intelligence is that, again, public markets where they're going, fixed income, commodities, everyone knows where everyone thinks they know where gold is heading. They're looking at, again, venture capital, different stages, ESG, to boost those portfolios because they have to find returns somewhere. Eric?
Yeah, so valuation is an interesting psychological proxy for really the entire venture asset class. I've always, my conversations with a wide range of LPs, they always look at venture in a relative basis, right? So if you're tied up for 10 plus years in a lot of these companies, what's my, illiquidity premium for doing venture versus public markets? So I think the context of your question and sort of where it's timely to ask that question today is when people look at what's happening in the public markets, S&P 500, NASDAQ, some of these, companies are at all-time highs. They got to say, well, where else is there going to be growth? Because they know that growth cannot be asymptotic in the public markets. That's why we are seeing so much of that rotation of capital into the late stage private markets, right? Where there's still this perception, and actually there are very clear use cases of, companies feel very highly valued in that pre-IPO round. They go public and they trade 50% up in one day. So whether, I think so there is some elements of that rotation of capital is temporal in the sense that the momentum and the pace of how much capital is coming in could be an artifact of the fact that there feels like there's saturation of growth in terms of the public markets. But if you kind of play this movie forward 6 months from now, a year from now, and maybe things start to moderate and sort of the convergence of sort of economic reality in the public markets, it's still going to fundamentally come down to this question about valuations in venture relative to valuations in other asset classes vis-a-vis that illiquidity premium. And I think that's a constant question that Chris and I think about. And the way we answer that question is different for different people, whether you're a family office here or you're a private bank in Asia. There's different variables that you need to impute to answer that question. I think that's just wanted to put that out there as a framework as you ask that question, as that's always ever present in this evaluation of whether or not you want to be doing venture capital.
For sure. And we're just about ready to get to really living up to the title in terms of a different perspective and approach on access. So we wanted to kind of build a little bit up into that. There's a question that kind of segues into that pretty well that just came in without giving away too much of the story before I get to the core question. One of our viewers notes, access is obviously important in venture capital. Companies going private more slowly. There have been half as many listed companies in the US as there were 10 years ago. How do you recommend family offices distinguish venture capital firms and what makes them so special?
Chris, you want to start with the family office perspective, and then maybe I'll provide some kind of practical advice?
Sure. Every family office event, or when we talk to people in family offices, you got to make that joke. When you meet 100 family offices, you meet 100 different family offices that want to do different, insert whatever number you want to insert, right? So I think it's a good question. I think just from personal experience, we were based out in Hong Kong. We thought about venture by geography because we, and by, the three founders of the family office now, sort of private investment firm, West 22nd, were all from the United States, all had different backgrounds. And we basically could settle on, the only thing we really settled on was that let's break it down by geography and kind of select by different cities because we felt that venture was hyper local. You have to be on the ground to get that access. And then three, be on the ground lets you sort of follow different engineers, different founders as they let their ideas bubble up to the surface. So nothing revolutionary in terms of asset allocation, but we broke it down by cities and by sort of, and then by sectors. So I don't know if that helps, but I think once you figure that out and that's the strategy, then you kind of figure out, okay, does that venture capital firm fit within the stages of what investments I want to do? What sectors do they cover? Do I need co-investments? Do I need sort of these different questions answered? I would say Asian investors like the sort of knowledge sharing aspect. They are all entrepreneurs. Most of them are first gen wealth, high risk in their companies, high reward, and now sort of will back entrepreneurs and understand sort of venture capital. But I think they also see venture capital GPs as when you invest in them, they become part of your family, right? Family is a big concept out in these different countries. So, they are the first port of call when they say go to Los Angeles, when they go to San Francisco, New York, Austin, et cetera, that they provide that know-how, that sort of, that secret sauce, and they share that with them to learn more about that sector so that they can bring these companies potentially as strategic investors to Asia through their businesses, or just have a better understanding of saying, these are my guys. And by the way, I have my sort of network in Asia. I'll introduce you to them and the companies, et cetera. So I'm not sure if that answers the question, but just from a practical perspective in terms of vetting the funds, just make sure, there's a lot of good funds out there. There's an upper sort of crust that's the top decile. But, within there, different funds have different approaches to how they see their LPs, whether they just want them to be quiet and just sort of be there and, every quarter they have an annual meeting and they call it a day, or the other specialists that really see sort of the value in building a community. It takes a network. So I think the first, group of prop tech funds that we invested in really saw the importance of community and sort of getting the big developers, the REITs, the real estate developers, the component people, et cetera, and putting them into a community. They were very good with sharing. So I would say, figure out what you want, how what you need, and then find the managers that perform in a certain way to provide what you need as a family office. Eric?
Yeah. The one thing I'd add to that, and sort of an alternative viewpoint is think about, so the family offices that I've seen and followed that have become very successful in venture, they've always started the premise of doing venture in the ethos of this is kind of an educational process, meaning it takes time, it takes energy, it's going to take capital to learn, right? Because again, if you're not putting capital work, none of these fund managers are going to take you seriously. But if you have the right frame of mind and a sufficiently long time horizon, you absolutely can do venture the right way. You can find good gatekeepers, you can find good advisors. Obviously, the portfolio of companies and funds you invest in will be part of that guiding light. But I always kind of ask that fundamental question because so much of where people go wrong is they kind of try to time the markets, or they come in and out, or they have one bad experience in terms of one company, or fundamentally actually they a lot of folks shouldn't be taking single company or single fund risk. They should be much more passive in nature, right? But again, this is sort of the sort of the polarizing effect of nature of if you're optimizing for risk and return, maybe that fund of funds approach, or maybe an index like approach could be well suited. But again, so much of the allure is to be able to interact with CEOs and look at companies and technologies and see how those technologies can actually impact your particular network. So finding right balance. So I think it's frame of mind as going into looking at this asset class, and finding the right balance between the trade-off of financial returns and strategic interest. That becomes I would say a credible roadmap for success.
And there is a lot of questions, which is a good sign of our special guest today. And I'm 99% sure I'm going to be able to get to them. But there's really, again, I don't want to leave people hanging on, hey, this new way to access venture capital. We've been kind of delaying it a little bit. So we'll start to get into a sequence of questions before I get to the member questions in a second. And I will start, I guess, with Chris. What are some of the new ways to access venture capital as an asset class outside of betting on one company, one manager, or investing in a fund of funds?
Yeah, this is Eric. You want to take this one? Probably, our head of product should probably talk about new products. I'll defer to Eric.
Yeah, I would say the background here is I've kind of I've been at that large fund of funds, so I've seen how the institutional LP process works and how decisions are made and how portfolios are constructed. The last 2 years at AngelList, I've seen what democratization of access can look like for retail and credit investors, and I've seen the power of fintech, and I've seen the power of this emergent community of operator angels. And so that as the data points in developing and prototyping these approaches essentially leads us to the conclusion, Chris and I call it the 95 and 5 rule. There's 5% of the sort of population who are doing venture that have access, that have teams on the ground, that have sort of a wherewithal to really get smart and sophisticated about venture. And there's 95% of people who think they want to do that, but really can't do that and should not be doing that, right? So that 95% is really this target audience that, as we alluded to before, should be, playing venture in a passive capacity, passive and thematic, meaning, is there the version of the S&P 500 index fund for venture? What does that look like? And how does someone construct it? And how do we make that investable? There's the NASDAQ biotech ETF, right? So a family office looking to express a view or an opinion about a particular sector, is there a diversified basket that they can trade into and out of, right? And build a portfolio around that. So the premise of the product development of what Chris and I are trying to do is in the same model that Vanguard kind of pioneered index funds, which led to ETFs. We think there's that similar construct today that should be built for venture capital. Obviously, we need infrastructure around that. We need heightened awareness. We obviously need capital, right, to prove out that model. But simply introducing the idea and building education around that is what we think is going to be very, very important for unlocking that capital coming from that 95% that has historically not participated in venture.
And a little bit of a question related to that. So there are platforms now, EquityZen, Forge, that provide greater access to deals, especially probably more later stage. And Eric, where you came from, as mentioned before, with AngelList as a great way to play in the earlier stage. So retail investors, if I could use that verbiage, really have more choices, and maybe that's not always good, than ever before.
Yeah, that's right. And I think, Chris, why don't you take this one? I think
I was just going to say the platforms are great. I would say anything that democratizes access to an asset class, with certain constraints and, people know what they're getting themselves into, is a good thing. Like, we get asked that question a lot in terms of our views toward Forge, all the other incumbents and players that you mentioned. There's a whole wave of these players coming out of, LATAM, Europe, Asia, that are looking to compete and sort of bring deal flow to their investors. And it's interesting. I think it's great for sort of the asset class. But I think, Angelo, you correctly pointed out, it comes with a sticker and should say, there should be warnings in terms of, only certain investors should play in the space, should know what you're trying to do and how to do it. But we're all for it. We think, regulated spaces, democratizing access, introducing more liquidity into this, somewhat illiquid asset class is a really good thing. Eric?
Yeah, and Angela, to extend this analogy about the access point, democratization, and what are the right products, venture today has become much more of a distribution business, or that's our fundamental thesis, in the sense that it used to be a one-to-one connection of capital. That principal who wanted to buy into venture would have direct access or try to get direct access to those companies or funds. And what we found today in our conversations with a number of private banks, a number of private wealth management groups, and registered investment advisor platforms, there's a layer of a gatekeeper who is managing that client's money, and they have a particular sort of asset allocation approach or philosophy that venture has to fit nicely into. So up to this point, no one has really provided product and service to those gatekeeper communities. And we think there's a large number of these newer platforms that are starting, that are managing a lot of capital, that are going to be rotating into alternative investments, and by default, that's going to include venture. And so a lot of this kind of distribution network really does need product, and that product has to be simple, easy to understand, easy to articulate to their clients, and it's got to look similar to how they buy other asset classes, right? And this is why we bring in that analogy of ETFs and index funds. If you can say it's just like how you're buying into some of these ETFs in the public markets, but it just happens to be private companies, and by the way, here's a menu of different suites to express that view, that's something that they can wrap their arms around. So I would say the mechanism of how capital flows into venture is informing some of these new models that we are trying to prototype.
And I have a follow-up question to that that's important, but actually a comment came in from one of the viewers: markets equal liquidity plus transparency. And don't forget that second part is kind of important too. Now, the underlying, if it's a case of a manager in VC, they're going to have, of course, a layer of transparency, but that's going to be a huge difference between public and private. It's just far harder to really, I guess you could say, know all the facts. Now, you could also argue that makes it a far more inefficient business for technologies to make certain decisions. It's a chance for, humans to really shine. There's inefficiencies in the market. That's complex. I mean, that's the whole magic, like you said, of an illiquid premium is I don't know necessarily everything. I'm trusting in a manager that may have deeper experiences and a diversity in what they own. And I'm hopeful it gets whatever, 400 or 500 basis points above what I would have if I was completely liquid in the public markets.
Yeah, that I think is going to be, let's continue. I think the transparency and liquidity are going to be just ever-present characteristics of venture capital. And I think there's ways that we can bring greater transparency. There's ways that we can mitigate some of that liquidity risk. Some of this is going to involve technology, right? So on the transparency side with Carta, right? So people have mentioned Carta before. Carta is, probably the largest platform for managing the ownership structures and documents of private companies. So it is effectively the universal truth of who owns what in the venture ecosystem. Now, how people report into revenues and things like that, I mean, that's always going to be a little bit of an art versus a science, because we know that there's different ways that startups can define different types of metrics to kind of play into what fits for them. But I think the transparency side is going to involve an element of fintech and demands from this new pool of capital looking to do venture, right? So if there is this index-like approach, and that index approach is managing sufficient capital that says that micro VC fund, if they're investing in that fund or investing in one of the companies, has to have a certain template of reporting, that's going to be part of what sort of eliminates or de-risks some of this transparency layer. Now, again, the earlier stage you go, it becomes less of a factor, right? In my opinion, because again, so much of the power law distribution of venture is, you're simply just betting on the handful of outliers, and how those outliers become outliers really doesn't matter whether or not they're reporting, their financials or not reporting their financials. There's some other factors that lead into that. But I think the liquidity piece, and I think if just to spend a minute on that, that is really the critical piece, because for the new wave and the new capital coming into venture, if you can somehow solve the liquidity piece, meaning you're not making it liquid or tradable, but you're creating greater avenues for people to, let's say, do an LP transfer, or create a redemption program for LPs after 5 years if the fund is marked up at a certain NAV. Those are all things that are actually in development, right? So I know some of the questions talked about secondary markets in exchanges, Carta's creating their own exchange. The infrastructure is starting to happen. It's starting at that later stage unicorn layer. It will absolutely move down to the early stage. So as that infrastructure is built and as they become widely accepted, mechanisms of trade, then every fund and potentially every company will have a mechanism for liquidity, and that is going to be a good thing.
And how is your approach similar or dissimilar from like ETFs or index funds?
So they're similar. They're not exactly analogous because it doesn't have the entire definition of an ETF being, daily tradable, mark to market every day. But it's got components. And again, Chris and I always talk about this, and Chris can maybe give one or two stories. We anchor the conversations by using these terms because we want people to recognize that there's that metaphor of how people are buying venture and how they can evaluate risk return of venture in the same apples to apples psychological context of how they're thinking about public markets. And so that's why we use this sort of spirit of the word. It's not a true definition of an index or an ETF, but I think it's going to start promoting the conversation and hopefully bring other service providers and other fund managers who think in a similar fashion.
Yeah, and that's where sort of, Angelo, you mentioned the different platforms where most people see them as competitors to people who either run their own fund, their fund of funds, or develop products. Again, we don't see it that way. We see it as, another place where they have their own marketplaces, their distribution channel, no app, no sort of GP or whatever can really replicate the relationships that say Credit Suisse or a Carta or another secondary market has, a NASDAQ, sort of next gen market, et cetera. So, applying those, the cop out, so to speak, is always applying ETF principles to venture capital. So data driven, an indexing approach, passive investing, not daily, mark to market liquidity, but not 10 years either, or 12 years or whatnot. Or relying on sort of, the GP to lift restrictions, LP restrictions in terms of transfer, messing with sort of fund NAVs and that type of thing. Doesn't work like that. It's more sort of within prescribed windows, similar to what you would see in public markets with, insiders selling their shares. Prescribed windows, and then orderly sort of sell downs in that respect, relying on partners such as Forge and whatnot that we hope to develop one day.
I mean, I guess you could say that most investors, especially arguably in today's times because of transparency, liquidity, cash is king, et cetera, they emphasize liquidity. And like you said, what you're doing is unique, but it's not there yet from that perspective. But as various platforms, Carta, Zambato, and there's others, real-time information and greater liquidity than what they may currently have, it's just about here. It looks like you guys are pushing that envelope. That's a great thing.
Yeah, that's right. The market will be there before we know it. And it's, and again, we use this product analogy, right? We need the engine for bringing capital into venture is new product, right? And again, product being different from a fund company or a fund of funds, right? We need different types of products, and that's where we're excited to be kind of part of this next wave of people pioneering those products.
Yes, you sure are. I mean, we spoke offline. I mean, look at the industry, approximately the 50s, meaning 1950s with Silicon Valley, the GPLP structure, and basically how things are done have not changed in a long, long time. You then had AngelList came along and that kind of shook things up. And, one of our members and participants today, someone like Dave McClure, who's invested in 1,000+ companies, and some of the leverage and successes that Akal Kanis has had on AngelList, et cetera, and the syndicate model. So really, it's just in the last 13, 14 years that you're starting to see a bit of a shift. And like many things, it looks like it may have started and stopped and stalled, but for the reasons that we noted today, and the examples of greater liquidity options coming, it looks like that's gonna rev up and be a lot of different dynamics, which is good, you would think, on the surface for the end investor.
Absolutely, we agree. We good. At the end of the day, innovation is good. It's just being able to to belabor this. It's product market fit, right? So meaning there's so many different ways to slice venture today that each slice has an appropriate home for a certain type of LP based on that risk return and liquidity profile. And I think the education and the product mechanisms to match that risk return profile with the appropriate strategy, that hasn't been done before, right? And that's the part that we think is going to be pretty powerful in that acceleration of what you just talked about.
And we have a couple of more minutes left. I do have a hard stop today. I'll try to get to one or two of the member questions if we could keep the responses a little bit concise so I could potentially get to as many as possible, and then we could do a bit of a close. One of the questions coming in, what are your thoughts on the missing middle of post friends and family type of checks and the fact that most institutional investors require or are required to write larger checks? Any systems, programs, or fund of funds helping to close this gap?
Yeah, so the gap between the friends and family to the institutional round today, if you wanted to classify that, that's sort of that pre-seed to early seed round. There is a large and growing network of angel investors that are quite active. And again, I'll point to AngelList since that's real data that I can point to. I mean, there's, well over, 300 different syndicates on AngelList where there's an individual angel investor that is bringing their deal flow to the platform. And they have a particular thesis or thematic of how they invest and what types of companies they invest. That is a very, that's a bona fide channel for finding that capital at that gap. There's a lot of, micro VCs, as we talked about before, and even micro VC today, is, do you call a $10 million fund a micro VC? Is it a nano fund? I mean, so there are specialists, and I think this is where the specialization is important. So if you have a particular company at that stage and sector, there's going to be a fit somewhere. And it's about finding the right fit with that particular investor, whether it's an angel investor or one of these small funds.
And I'm going to try to shorten what probably is going to need to be our last question from Chris Ray. With the pandemic and the higher bar for doing diligence on venture investing, parentheses, how can on-site meetings, you can't do them when you can't leave the house. Do you think there will be a resurgence of fund of venture funds who have the capability to act as an advisor for family office because they can't provide the resources to family offices that internally for most family offices are going to be simply too expensive?
Yeah, that's a good question. I think we've actually, funny enough, or coincidentally, if it's difficult from us, in the East Bay going to San Francisco, can you imagine sort of the family out in LATAM or Asia coming out here when they don't want to fly for that diligence session? So I think you're going to see more. I wouldn't say it's innovation because it's more sort of an advisory service, similar to lawyers, accountants, right, investment banking, et cetera, but outsourced sort of venture partner services where you're able to, not necessarily be a GP that helps with, doing the diligence on a company, but outsource teams that basically are in different regions that know it very well, that can help you with sort of back channeling, doing verification, on-site management, and connecting with those companies. We're seeing that. I think we've been trying to offer, not a sales pitch, but we've been offering sort of the services for Asian friends, Asia-based friends, given the inability to fly. So I think look for that as that outsourced local venture partner model, or your outsourced sort of extension of the team. I think just because of public health issues, you're going to see more of those types of services being offered.
And gentlemen, this has been really great. I mean, there's lots of opportunity here to change the dynamic. You guys are certainly taking a lead with it. It's obviously very early stage, but we like to cover this. For those that would like to learn more, because you have very intriguing backgrounds and what you're doing is interesting, how could they learn more? Where could they go for more information?
Eric, did you want to chime in? I mean, we're always happy. We talk about this stuff all day, literally. Mondays, early mornings, Europe. During the day is US. And then Asia starts around 5:30 when they crawl out of bed. So we're always happy to talk. I saw some of the really good questions in the chat. Happy to connect through Angelo, be value additive to whatever you're doing, whether that's venture capital or sort of cross-border things into Asia.
And in terms of, because it may be better simply to have a direct connection, is there an email or a website, a blog post or something where they could connect from that perspective? Or if you're very active on a social media handle, your Twitter handle, how could they best connect from that perspective?
I'll go ahead and drop our email in here. Eric.
Yeah, we'll put our email here in the chat. I mean, it's either Eric, ERIC at projectm.ventures or Chris at projectm.ventures. And again, Angelo, it's all about, it all starts with education. So we want to just further spread the awareness of kind of these different approaches, and happy to talk to anyone here on the chat or as this gets broadcast.
Yes, and what I will do is I'm going to read the website. It's www.projectm.ventures. And then Chris and Eric is spelled with a C, would be their first name. Let's use Chris as the example. Chris at projectm.ventures. Well, this has been great. I very much look forward to watching you guys and seeing the progress and being really a game changer in, ironically, because what angel and VC you think would be on the cutting edge, but tends to be a very protective and a little bit of an old guard, again, some irony, community, but things are changing. And to some degree, the pandemic and the challenges we're going through is kind of causing some of this. So interesting times indeed. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth and their family offices, doing or outputting a tremendous amount of original proprietary content, really now more than ever, hosting global programming, on hold because of COVID, but I think went from doing 10 events a year to doing 200 because Monday through Friday, almost all the time, we're so busy with our daily Zooms with our members and special guests as noted, and so much more that we offer. I highly recommend taking a look at our new website. We're very excited. It was a lot of work. www.familyofficeassociation.com. So the same URL is forever since by day one, but does simply the content, the site's completely new. So very exciting. Very active on social media, mainly YouTube. You could find me at Family Office. So you all know how to find me. On that note, thank you so much. It was great. Chris and Eric, I appreciate it. Thank you to our live audience and look forward to the next time.
Thank you, Angelo.
Thank you.
Thanks for having us.
Thank you.
Thank you, everybody. Take care.